You've heard the rule. You should have an emergency fund with 3 to 6 months of expenses sitting in a savings account. Honestly, it sounds responsible. It sounds like the kind of advice adults are supposed to give each other, like flossing or rotating your tires. And because it sounds so responsible, it can also make you feel behind if you don't have that money saved yet. But here's where I think we need to slow down a little. For a lot of people, the emergency rule just might be wrong, or at least wrong based on your specific situation. Cookie cutter advice like the emergency fund rule might not always be the best advice. So let's reframe it. Hi, I'm Chris, and this is Finance Reframed, where I take common financial advice and reframe it for real life. Today, we're going to look at the emergency fund rule. Instead of just adopting that rule into our lives, I think it's better to ask a question. If life takes an unexpected turn, can you handle it without the situation becoming a disaster? That's really what we're trying to figure out. Not whether you hit some exact savings target somebody gave you, but whether your financial life is strong enough and flexible enough to absorb a shock. Resilience is more than just what's in your savings account. It's the full set of options available to you when something goes wrong. And to be clear, cash can absolutely help with that. If the car breaks down, or if your hours get cut, your air conditioner dies in the middle of July, because of course it does, having money available can really make a difference. But the problem is that the rule often gets treated like it's the first commandment of personal finance. Before you do anything else, thou shalt save 3 to 6 months of expenses in cash. And that can lead people in the wrong direction. So what could go wrong? If you focus on one savings number, you might stop looking at what's happening everywhere else in your financial life. For example, let's say you're trying to build a large emergency fund while you're also carrying credit card debt at 20 to 25% interest. You may be making one number look better while your overall financial position is getting worse. That's the part the simple rule like the emergency fund can miss. It tells you build cash, but it doesn't ask what that cash is costing you. And this is where an idea called net worth can help us see the trade-off more clearly. Net worth is simply what you own minus what you owe. So if your savings account is growing, but your debt is growing faster, your net worth is moving in the wrong direction, even though the savings balance is getting bigger. That doesn't mean you shouldn't keep any cash, but how much cash you should hold is one part of a larger plan centered around your overall financial resilience. Let's walk through some of the common sources of resilience. These are the things that give you options when life gets messy. An important thing to remember is that they work together. You don't need one perfect solution. You need a combination of strong enough approaches that can get you through a financial disruption. The first source is income stability, and this is a pretty quick check. Basically, how reliable is your paycheck? How long would it probably take you to recover if that paycheck changed? If you have a steady employer, in-demand skills, or 2 incomes in your household, especially if those incomes are from different industries, you may have more resilience than someone whose income is unpredictable. That doesn't mean you're risk-free. Anyone can lose a job, anyone can have their hours cut. But if you work in a field where layoffs are rare, or you could reasonably find another job pretty quick, your situation's different from somebody who's self-employed, commission-based, seasonal, or working in an industry that goes through sharp ups and downs over time. The second source I'll talk about is cash flow flexibility. When people ask if they can afford something, they often think about their monthly cash flow. Can I make the payment? Do I have enough money coming in to cover my expenses? But when we're talking about resilience, we need to look at cash flow a little differently. The question is not just whether your monthly budget works when everything is good. We want to think about how much flexibility you have when things are not great. Start with the bills that are hard to avoid. Mortgage, rent, car payments, insurance, utilities, childcare, minimum debt payments. Oh my goodness, there's a lot. Think about all those that you cannot avoid. Those are your anchors. They do not move easily. And if too much of your monthly income is locked up in these fixed obligations, then your financial life is not very flexible. Look at the rest of your spending. What could you pause if you had to? Dining out, travel, convenience expenses, your TV and movie streaming service, your second TV streaming service, your third TV streaming service, why did we get rid of cable? Anyway, Or maybe you have some really expensive hobbies like, I don't know, Magic the Gathering. The more that you can limit your spending during a crisis and cut out hobby entertainment or convenience expenses, then the more resilient you are. If you can shrink your spending, you buy time. Time to update your resume, reach out to your network, line up some interviews, call a lender and ask what options exist for, renegotiating your payments. You just have time to make a decision without panicking. When money gets tight, it comes with a lot of pressure. Having a plan that outlines what expenses you can cancel, what you can put on hold, can help you really act when a crisis occurs. A lot of streaming services, I found out, have options right in your account where you can go and click pause for months at a time sometimes. So put together a checklist, have that ready so you can start to take control quickly if a problem does arise. Credit also fits into this part of the conversation because for many people, credit cards are a part of their financial backup system. Credit cards are powerful. They help build credit history. They create borrowing capacity. They can act as a temporary bridge if something unexpected happens. But as we know, with great power comes great responsibility. Instant access to spending power is a big deal. It's probably why a lot of finance advice just writes off credit cards and treats them like a trap. But this is something I've struggled with over the years. A lot of financial advice, they say that approaches are either good or bad based on some assumptions they're making about you and your situation. That's the reason I started this channel, to reframe some of the common advice that years of personal experience and analysis led me to question. And credit, I feel, is an important tool that can be used to provide financial resilience. You just have to understand it should be a short-term bridge, and you should have a strict plan for paying it off when things return to normal and you can afford to do so, and before you restart all of your streaming services. All right, so how do you get a good understanding of your cash flow flexibility? You don't need to be perfect. You don't have to have an ultra detailed budget, but you do need to understand your numbers well enough to know what would happen if your income dropped or if you had to replace your air conditioning in the middle of July. I use an online tool called Monarch to track this. I researched a few options. This one was easy to use. I really like the visual outputs. It made it easy to see where my money was going each month. Like, for example, how much money actually does go to Magic cards. I'm here mainly to share my experiences, not to sell things. If you do want to try Monarch, you can use the link below, and that'll help me offset some of the costs of this channel. But at the end, the tool you use doesn't really matter. What matters is you knowing your numbers. If you can cut 20%, 30% of your spending in a tough month, that's a real source of resilience. On the other hand, if you're like, oh goodness, I don't have any room to cut anything back, well then this part of your financial life is a little bit weaker, and you may need to find some strength somewhere else. A third source of resilience is balance sheet strength, or your net worth. This is where we zoom out from the monthly budget and we look at your overall financial position. What you own, what you owe, whether that picture is getting stronger or weaker over time. This matters because resilience is not just about surviving this month. It's about whether the decisions you're making today leave you in a better or worse position over time. Your debt structure is a big part of this. Some debt has a built-in path to zero. That word that nobody knows what it means. Well, it kind of means your debt has a built-in path to zero. So mortgages, auto loans usually work this way. If you make the payment, the debt balance goes down and eventually it goes to zero. No more payments and you own the asset. Revolving debt is different. Credit cards that don't have a finish line. If you make payments and you keep charging even just a little bit, that balance can stick around for a very long time, like forever. And as they keep adding interest, it also increases your fixed monthly obligations that we talked about in cash flow, because the minimum payment on those credit cards is going to be getting larger and larger. That's why paying down high interest debt can be a form of emergency preparation. If paying down debt reduces interest, lowers your monthly cash flow pressure, improves your net worth, and gives you more room to maneuver later, then it can absolutely make your financial life more resilient over time. The fourth source of resilience we'll discuss is social capital. This is one that most financial checklists completely ignore, but real life does not. Social capital means the people, the relationships, institutions, and community resources you could rely on in a tough spot. People have family, friends, neighbors, schools, churches, libraries, community groups, all types of informal support systems. And in a crisis, those can be really helpful. If something went wrong tomorrow, could a family member help you with childcare for a few weeks? Could a friend help with transportation? Could someone offer a short-term loan without the 25% interest attached to it? Do you have access to food assistance, utility help, job support, other emergency resources in your community? And let me put in a plug here for public library, free internet, computer access, job search help, workshops, information, and a place to sit quietly where there's air conditioning and you don't have to buy a $7 coffee. Libraries do a lot more for community resilience than they get credit for. Another resource a lot of people don't know about is 211, a phone service supported by the United Way. In most of the United States, you can dial 211, you get connected with local resources for things like food, housing, utility assistance, mental health support, and other community services. It's confidential. It's available 24 hours a day in many areas. It can be a useful starting point, especially if you're dealing with a problem for the first time and you don't even know what resources are out there. Thinking back to the emergency fund, if you have sources of social capital, it can reduce the size of the cash cushion that you need. Some communities have a lot of resources and others are stretched thin, but social capital definitely belongs in the conversation. When we put all this together, the emergency fund rule starts to look a little too narrow. The question's not simply, do I have 3 to 6 months of expenses in cash? Check, I'm an adult. A better question is, how resilient is my financial life? How stable is my income? How flexible are my expenses? Is my net worth getting stronger or weaker over time? Do I have responsible access to credit if I need a short-term bridge? Do I have people, institutions, or community resources I can turn to before a problem becomes a disaster? And yes, how much cash do I have sitting around? Cash still matters, but it's just one part of a larger picture. The point is not to reject the emergency fund concept, but we should stop treating it like a moral test. Instead, focus how able we are to absorb a financial shock without it sending us into a spiral. That's the reframe. The emergency fund is not the goal, resilience is the goal. With that goal in mind, you can consider your situation and find the right combination of tools that will maximize your chance for success. Earlier, we talked about net worth as one of the tools that you can use to help see whether your financial position is getting stronger or weaker over time. If you want to go deeper on that, click this video next, where I'll explain what net worth is, how to calculate it, and why it can be one of the clearest ways to understand your long-term financial future.